Welcome to this deep dive. Today, we're really digging into the world of quantitative finance. You might know it as quant finance.
That's right.
Think of this session as maybe your foundational lecture on the whole subject. We've pulled together academic reviews, some career discussion points, definitions, really trying to get under the hood of it all.
hmm
Our mission really is to unpack what quantitative finance is about, why it's so important today, and look at the core concepts and tools these quantitative analysts, the quants, use every day.
Okay. So at its heart, quantitative finance is all about applying some pretty serious mathematical tools. We're talking models, statistics,
The
coding.
heavy stuff.
Exactly. Applying all that to analyze financial markets and, the different things traded on them.
Yeah.
Securities.
Right.
And quants use these tools with, well, a few main goals. They're building models to try and predict market
Where
trends.
things are going.
Yeah. Or trying to figure out the right price
Mm.
for complex financial products. Derivatives are a big one there. And maybe most crucially, measuring and managing financial risk. That's huge.
Okay, let's unpack that a bit more. When you say these mathematical tools, what does that actually look like, day to day? What kind of problems are they solving?
Well, the applications are actually pretty broad. For instance, a quant might build a really complex model just to value an option contract.
Okay, a derivative.
Exactly. Its value depends on something else, an underlying asset.
Yeah.
Or others might focus more on forecasting, looking at those bigger market trends to help investment decisions.
Mm-hmm.
Building stock portfolios, that's another common one. Trying to optimize them for specific risk and return targets.
So balancing risk and reward mathematically.
Precisely. Some quants design algorithmic trading strategies. These are basically sets of rules, quantitative rules, that execute trades automatically.
Wow.
And you might find this surprising, but even looking at stuff like consumer shopping habits can be part of it, if the goal is to pull out financially relevant information.
Huh. It sounds very modern, very high tech, but I imagine it must have some history. It didn't just appear, right?
Oh, absolutely not. It's definitely come into its own more recently. But the groundwork, um, it was laid much, much earlier.
Yeah.
You can actually trace some roots back to Louis Bachelay.
Bachelor. When was this?
Way back in 1900, he was really a pioneer.
Yeah.
He used Brownian motion, that mathematical concept for random movement.
Right, like particles moving randomly.
Exactly. He used that to
I
model
see.
stock prices. Interestingly, his work didn't really catch on immediately, kind of ahead of its time.
Fascinating. So who are the big names then, the people who really push these math ideas into like mainstream finance?
The period from the 1950s to the 70s was really key. You had Harry Markowitz in the 50s. His work on portfolio selection was a major turning point. He was really the one who formally brought mathematical concepts into how we think about managing investments.
Okay, mark a bit.
Then others built on that: William Sharpe, Paul Samuelson, Robert Merton, all big names. But arguably, the huge breakthrough, the one everyone knows, was the Black-Scholes model.
Ah, yes, Black Scholes.
Yeah.
Early 70s.
That's right. Developed by Fisher Black and Myron Scholes, and Robert Merton made really significant contributions too. It gave a practical way to price options using pretty advanced math, stochastic concepts. It really revolutionized things.
Okay, so it's clear they're using some serious mathematical power tools. What are the absolute must-haves, the core math and computational skills a quant needs?
Well, you need a solid foundation in several areas of math. Probability and statistics are just fundamental. You need them for analyzing data, assessing risk. It's the bedrock.
Makes sense.
Then stochastic processes, that's essential. Think of it as the language for handling randomness over time. Crucial in markets, especially for pricing those derivatives we mentioned.
Right, modeling the unpredictable.
It's exactly.
Yeah.
Calculus helps model continuous changes, price movements, interest rates, things like that. Linear algebra is vital for handling big data sets, like when you're optimizing a portfolio with hundreds of stocks.
Got it. Lots of data.
And finally, optimization techniques. These are used to find the best solution, like maximizing your return while keeping risk under control.
That's a lot of math. What about the computational side? It's not just pencil and paper, I assume?
Definitely not. The computational side is equally critical. This involves things like numerical analysis, basically, finding practical, approximate answers when the pure math gets too messy for a neat solution.
Okay.
And of course, all sorts of statistical computing methods for actually working with the data. Simulations are also a big deal.
Simulations, like running scenarios.
Precisely. Monte Carlo simulations are a classic example.
Huh.
Quants use them to run thousands, sometimes millions, of possible future market scenarios. It helps understand how investments might behave under different conditions, how the whole system reacts to uncertainty.
So beyond the math and the code, they obviously need to understand the actual things they're analyzing, the financial instruments themselves.
Oh, absolutely. Non-negotiable. You need a strong grasp of the basics. That means understanding stocks, equities, owning a piece of a company,
Right.
bonds, which are basically debt, loans, and derivatives, as we keep mentioning contracts, whose value is tied to something else, like options or futures.
Okay.
And also knowing about investment funds, like mutual funds and ETFs.
BTS, exchange traded funds, those are everywhere now.
Exactly. Baskets of assets you can trade like a single stock. Very common.
And with markets being, well, volatile, risk management must be a constant focus.
It's absolutely central. A huge part of the job is identifying and really understanding the different kinds of financial risk.
Like what? What are the main types?
Well, there's market risk, just the risk that prices will move against you. Credit risk, the chance someone defaults on a debt.
Right, they don't pay you back.
Exactly. Liquidity risk, that's about how easily you can buy or sell something without messing up the price too much.
Okay, hard to sell quickly if needed.
And operational risk that covers things like system failures, human error, fraud even. And quants also think about systematic versus unsystematic risk.
Systematic is market-wide, unsystematic is company-specific.
You got it. Systematic risk affects everyone, like a recession. Unsystematic risk is tied to a specific company or maybe an industry sector.
Okay. And finally, on the investment side, how do they know if they're actually doing a good job? How are returns measured?
Well, measuring returns is obviously key. It can come from capital gains, selling something for more than you paid,
Buy low, sell high.
the classic, or through income, like getting dividends from stocks or interest from bonds. But, and this is crucial for quants, they focus heavily on risk-adjusted return.
Ah, so not just the raw return number.
Exactly. It's about how much return you're getting for the amount of risk you took. A huge return isn't necessarily good if you took an insane amount of risk to get it. It's about the balance.
That makes a lot of sense. So with this pretty intense toolkit of math, coding, finance knowledge, where do these quants actually work? What kind of places hire them?
They're really in demand across the financial sector. You find them in commercial banks, investment banks, uh, wealth management
There's
firms.
big players.
Yeah. And definitely hedge funds, they get a lot of attention. But also insurance companies, financial consulting firms, and even companies that just build financial software. They all need quants.
And within those firms, are the roles pretty similar or are there different types of quant jobs?
Oh, there are definitely different flavors. A common distinction is between front office and back office quants.
Okay, what's the difference?
Front office quants are typically closer to the trading action. They're building and maintaining the pricing models, the tools that traders use every single day.
Right there on the virtual trading floor, so to speak.
Pretty much. It can be very fast-paced, and their work directly impacts the firm's bottom line, profit and loss.
Sounds high pressure. What about the back office then? Less intense?
Maybe less immediate pressure, but equally important.
Hmm.
Back office quants often focus more on model validation.
Checking the models work correctly.
Exactly. Making sure the models the firm relies on are sound, accurate, reliable. They also do more in-depth research, maybe developing totally new trading strategies.
Okay.
And in places like banks and insurance companies, back office quants often have a stronger focus on overall risk management for the firm.
Hmm.
It's also worth noting, quantitative research roles, the really deep R&D stuff, that tends to be concentrated in investment banking.
Got it.
But really, whether front or back office, technology is it's critical, hugely important for all of them.
It seems clear that these mathematical models are really the absolute core of quantitative finance. Why are they so important? What's their fundamental role?
They really are the engine.
Yeah.
Their main job is to give us insights into incredibly complex financial systems. Insights you probably wouldn't get just from, intuition or experience alone. They get used for all sorts of crucial things. Pricing securities, pricing derivatives, informing decisions about when to trade, and, as we've said, assessing and managing all those different financial risks.
Are these models always, perfect? Do they always agree?
Ah, that's a really key point. No, they're not perfect. Their effectiveness, their efficacy is vital. And quants have this big responsibility to strike a balance
A balance between what?
between how complete or complex a model is, how many real-world factors it tries to capture, and its parsimony, simplicity.
Right, simpler is easier but might miss things.
Exactly. A simpler model might be easier to work with, to understand, but it could overlook important nuances.
Hmm.
A super complex model might be more accurate on paper, but maybe it's harder to use, computationally intensive, or even harder to understand why it's giving a certain answer.
Hmm.
And what's really interesting is that different models, perfectly valid models, can give you different prices for the exact same derivative.
Wow, really?
Oh, yeah. Which just highlights why you need real expertise. You need someone who understands the models, knows their assumptions, their limitations, and can choose the right one for the job and interpret the output correctly.
It definitely sounds like you need some very specialized training for this. Has the education side caught up? Are there specific programs for quant finance?
Absolutely. Especially since the mid-1990s, there's been a huge boom in specialized master's degree programs in quantitative finance.
Okay.
These programs are tailored to give students that deep understanding of financial instruments, portfolio theory, econometrics, risk management, and especially derivative pricing, all built on that strong math and computational foundation we talked about.
When did these programs really start taking off?
Well, the very first formal postgraduate program, according to our sources, was actually back in 1990 at the Illinois Institute of Technology.
Oh, interesting.
Yeah. And after that, other top universities globally saw the need and jumped in, developing their own programs. Sometimes they're called financial engineering or computational finance, slightly different names.
But similar focus.
Generally, yes. Today, you find these programs all over the world, which really reflects just how sophisticated and, well, quantitative finance has become globally.
With all these programs emerging, do they teach roughly the same things? Is there a standard quant curriculum?
It seems so. Our sources suggest there's a fair bit of similarity, a homogeneity across these programs. They tend to cover the same core subjects, emphasize applying mathematical finance to understand how markets actually work. And this similarity, both in the education and in how quant finance is practiced in the industry, it really points back to the strong influence of those early pioneers we mentioned. They really shaped the field.
So if someone listening is thinking, okay, this sounds interesting, maybe challenging, what kind of actual job titles or career paths are out there for quants?
It's quite varied, actually. You have the quantitative analyst role. That's kind of the classic. They're focused on developing and implementing the models.
Yeah.
Then there are quant developers. Their focus is more on the programming side, turning the models into robust, efficient code, building the software systems. Really crucial.
Tech implementers.
Exactly.
Yeah.
You also have algorithmic trading quants who specialize in designing those automated trading systems using advanced statistical techniques, machine learning sometimes.
Right.
Risk management quants are specifically focused on assessing risk, developing hedging strategies. And model validation quants, their whole job is to independently check and challenge the models the firm uses, a sort of internal audit for the math.
That sounds really important. What kind of background do people usually need to get into these roles?
Typically, you're looking at needing at least a master's degree, often a PhD, in a very quantitative field.
Like?
Well, it could be finance, but often it's economics with a heavy quant focus, or mathematics, statistics, physics even, engineering disciplines, computer science.
So a strong STEM background.
Definitely. And beyond the degree, strong programming skills are non-negotiable. C++, Python, SQL are usually top of the list. And being proficient with statistical software, things like MATLAB, R, SAS, that's usually expected too. It's a demanding path, no doubt. It blends math, finance, and computer skills.
Seems like it.
And while people are often drawn by the intellectual challenge, the quantitative problem-solving aspect, let's be honest, the earning potential is also a significant factor for many.
Understood. One last area. How is all the new technology like AI and big data changing the game for quantitative finance?
Oh, it's having a massive impact. Technology and big data are really reshaping things. Quants are increasingly using these huge data sets to build more complex, more nuanced models to find subtler patterns.
More data, better models, potentially.
That's the idea. And algorithmic trading, which is fundamentally driven by quant principles, just keeps getting faster and more sophisticated, arguably making markets more efficient through that automated execution. So yeah, quantitative finance is still very much a driving force for innovation in the financial world, creating new investment strategies, new products, really pushing the boundaries.
Okay, so let's try to sum up this foundational lecture then. Quantitative finance is clearly this highly specialized, deeply technical field. It uses powerful math and computing tools to navigate the, frankly, bewildering complexity of financial markets.
That sums it up well.
From pricing incredibly complex derivatives, to managing critical financial risks, to developing the algorithms that drive modern trading quants, play this absolutely vital, indispensable role. We really hope this deep dive has given you a solid grasp of the intellectual rigor involved, but also the very real-world practical applications that define this domain.
And perhaps that leaves you with a final thought to mull over. As we rely more and more on these incredibly sophisticated mathematical models in finance, how do we individuals, institutions, ensure not just their accuracy, but also their ethical and responsible use in this constantly changing financial landscape?
Yeah.
What responsibility do the creators of these powerful tools have to make sure they're properly understood and aren't perhaps inadvertently misused?
Yeah.
Something to think about.